On December 20, 2025, the Nigerian National Petroleum Company Limited issued a directive that drew significant attention in global markets. The announcement, presented in measured terms, began to attract the interest of financial analysts, policymakers, and energy traders internationally. Nigeria stated it would now accept payments for its crude oil exports in a range of currencies, including the Chinese yuan, Indian rupee, and a newly introduced digital currency from a coalition of emerging economies. This decision reflects ongoing changes in global trade and the increasing role of non-Western markets. Known as the Lagos Declaration, this policy represents a notable shift from the long-standing practice of trading oil exclusively in US dollars, a system that has shaped the global energy market since the 1970s. For Nigeria, Africa's largest oil producer, the move indicates an intention to achieve greater autonomy and influence in international commerce. The announcement prompted activity in currency markets. Traders began to reassess their positions as the implications of Nigeria's decision became clearer. Volatility increased and financial institutions worldwide started adjusting their risk models to consider a future with potentially reduced dollar dominance. For over 50 years, the petrodollar system has been a key element of American economic strength, supporting consistent global demand for the US dollar. This arrangement has enabled the United States to finance deficits and maintain influence over international markets. By choosing a different path, Nigeria is directly addressing this foundation and may set an example for other resource-rich nations. Nigerian officials outlined their reasoning, emphasizing the importance of a more balanced and inclusive global financial system. The White House issued statements expressing concern and encouraging stability. Internally, U.S. officials held a series of meetings to evaluate the potential for similar actions by other major energy exporters. The reduction in dollar-denominated transactions is one aspect of the situation. More broadly, there is a recognition that this development may signal a gradual shift in the structure of global finance. Nigeria's decision aligns with a wider trend among emerging economies to decrease reliance on the dollar and U.S.-centered financial systems. Countries such as China, India, and Brazil have expressed similar intentions in recent years. By implementing this policy, Nigeria positions itself as a participant in a growing movement toward a multipolar financial system. This development has the potential to influence the future structure of global economic relations. Throughout history, the fate of global reserve currencies has always been intertwined with the fortunes of empires. No currency, no matter how dominant, has ever held its position forever. The story of money is also the story of power, how it rises, how it wanes, and how it shapes the world order. Before the US dollar's reign, it was the British pound that stood at the center of global finance. Britain's industrial revolution, vast colonial network, and naval supremacy made the pound sterling the world's preferred currency for trade and reserves. But two devastating world wars drained Britain's resources and influence. In 1944, at Bretton Woods, the US dollar took center stage, backed by America's economic strength and its gold reserves. The dollar became the anchor of the new global financial system. When the US left the gold standard in 1971, the world didn't abandon the dollar. Instead, the petrodollar system, linking oil sales to the dollar, cemented its dominance, ensuring that global trade continued to flow through American currency. Yet, history reminds us that reserve currencies like the Dutch guilder and the British pound faded gradually, not overnight. As new economic powers emerged, old currencies lost their luster, replaced by those of rising nations. These transitions are rarely sudden. They unfold over decades, marked by moments when countries seek alternatives, hedge their bets, and diversify their reserves in response to shifting global realities. Nigeria's recent move is one such moment, a clear signal that the balance of economic power is shifting. As Africa's largest economy, Nigeria's decisions carry weight and reflect broader trends across emerging markets. The Lagos Declaration fits a historical pattern. As economic power spreads to new regions, so does the demand for a more diversified and resilient global currency system, one that reflects the realities of a multipolar world. The U.S. share of global GDP has been steadily declining, while countries like China, India, and Brazil are rising fast. Their growing influence is reshaping the global economic landscape and challenging the old order. Nigeria's action isn't an act of rebellion, it's a rational adaptation to a changing world, echoing the choices made by nations throughout history as new powers rise and old ones recede. It signals a future where economic power is more widely distributed, where no single currency or nation dominates unchallenged, and where the old financial order is gradually giving way to something new and more inclusive. Nigeria's decision matters because of its unique position as Africa's largest economy and a top global oil exporter. Its Bonny Light crude is a benchmark, and its energy policies influence markets far beyond Africa. Nigeria is also a regional trade hub with a booming tech sector and a young, dynamic population. By diversifying oil payment currencies, Nigeria sets a path for other African nations seeking economic autonomy. This could accelerate regional monetary integration and reduce reliance on external currencies. Nigeria's growing trade with China and India makes accepting their currencies a pragmatic move, reducing exposure to dollar fluctuations and U.S. sanctions. The decision is a calculated risk, opening new opportunities and strengthening Nigeria's position among emerging economies. It's a declaration of economic sovereignty, showing Nigeria can shape the future of global finance. Nigeria's move is part of a broader, coordinated strategy by emerging economies to build an alternative financial system, one that is less dependent on traditional Western-dominated institutions and more reflective of their own economic realities and ambitions. This shift is gaining momentum as more countries seek greater control over their financial futures. The BRICS Plus group has spent years developing new institutions, such as the New Development Bank and the Asian Infrastructure Investment Bank. These organizations offer loans in local currencies, reducing reliance on the US dollar and providing more tailored financial solutions for member countries. Their presence is reshaping the global lending landscape. These banks serve as credible alternatives to the IMF and World Bank, giving developing nations more options and negotiating power. By diversifying their sources of funding, countries can pursue development on their own terms, with fewer strings attached. Nigeria's acceptance of non-dollar payments aligns perfectly with this broader push for local currency use in trade. It encourages regional integration and strengthens economic ties among emerging markets, making cross-border transactions more accessible and efficient. Alternative payment systems, like China's CIPS and Russia's SPFS, are rapidly gaining traction. At the same time, BRICS nations are actively developing unified platforms for settlements, aiming to streamline international payments and reduce transaction costs. Nigeria's participation gives these systems a significant boost, helping to move the project from theory to practice. It demonstrates real-world commitment and encourages other nations to join in, accelerating the transition to a more diverse financial ecosystem. The goal isn't to collapse the old system, but to create a parallel one that reflects a multipolar world, where power and influence are more evenly distributed and countries have genuine choices in how they engage with global finance. This marks a tangible and historic shift in global trade and finance, signaling the rise of new players and the gradual transformation of the world's economic order. Officially, Washington and Europe have downplayed Nigeria's move, citing the dollar's and euro's stability and trust. Behind the scenes, however, policymakers are analyzing the long-term risks. The real worry isn't Nigeria alone, but the acceleration of de-dollarization. Sanctions have ironically pushed countries to seek alternatives, and Nigeria's action is a direct result. Aggressive responses would backfire, so the West will likely focus on reinforcing alliances and highlighting the benefits of the current system. The strategy is adaptation, not confrontation, accepting that unipolar dominance is ending. The challenge now is to manage the transition and preserve as much influence as possible. In Nigeria, the move is framed as a matter of sovereignty and economic pragmatism. Officials say it's about aligning trade policy with modern realities and strengthening ties with key partners. Supporters argue it will cut transaction costs and boost competitiveness while also fueling national pride. The decision is seen as reclaiming agency from a post-colonial economic order. Public debate is lively, with most seeing this as a step toward true economic independence. Critics worry about currency volatility and technical challenges, noting the dollar's unmatched stability. These concerns are real, but optimism prevails. Nigerians believe the long-term benefits outweigh the risks. The mood is one of resolve. Nigeria is charting its own economic destiny. The erosion of the dollar's reserve status has deep consequences for the U.S. This exorbitant privilege has let America finance deficits cheaply and import more than it exports. If global demand for dollars falls, borrowing costs will rise for the government, businesses, and consumers. The dollar's dominance has also been a powerful foreign policy tool, sanctions, and financial pressure. As countries like Nigeria use alternatives, U.S. leverage weakens. The shift will be gradual, not sudden, but Americans may see higher prices and interest rates. The government will have less fiscal space, forcing tough choices. The U.S. economy is resilient, but the end of dollar dominance means adapting to a more competitive world. America will remain powerful, but no longer the undisputed center. The era of easy privilege is ending, and adjustment is inevitable. De-dollarization is driven by economic pragmatism, not ideology. Countries like Nigeria are acting in their own interests, strengthening trade with fast-growing partners. Trading in local currencies or neutral alternatives reduces costs and currency risks. It's a practical business move that deepens economic ties and hedges against volatility. The rise of U.S. financial sanctions has shown that access to the dollar system is conditional, creating vulnerability. By building alternative payment channels, nations are managing risk and increasing resilience. These partnerships are about shared economic benefit, not shared politics. The world's economic power is already multipolar. This is just a logical adaptation. The new order reflects a reality where growth is distributed across many centers, not just one. The Lagos Declaration marks a turning point in the world's shift toward a multipolar economic order. The dollar's monopoly is ending, but it will remain important alongside other major currencies. The challenge is to manage this transition smoothly, avoiding global disruption. Coordination and robust financial infrastructure are essential to support a multi-currency system. For the U.S., the future means leading within a distributed system, not dominating it. Embracing innovation and open markets will keep the dollar competitive. The world is moving toward shared influence, not a new hegemon. The task now is to navigate this change wisely, building a stable and prosperous global future.